Welcome to the daily update, where I'll go over the action in the market for Wednesday, January 15th, and then we'll see how things look for Thursday, January 16th. Had a really nice bounce to CPI, and interest rates headed back down in Wednesday's session. That really sent the stock futures up. And so we saw a nice little pop. Now we have been seeing the smart money indicators have been coming in and doing some buying. Will that continue? There's still some hurdles that we have to get over if the market's going to keep going up. We haven't switched over to full-blown positive yet. It's kind of strange. We're back to looking positive in the short term because we're above the 20-day moving average. But we still haven't cleared the 50-day moving averages because the 20s have been coming down into the 50s. So we're going to be watching this to see on a daily basis, can we get back above the 50 period simple moving average? And then after Friday's session, close above it. That would really help things, not only on the daily charts, but also on the weekly charts, and really suggest more of a shift going back to positive. Okay, let's go back and talk about what happened here. Right at the open, we had a gap higher open above R2 at 5907. So we reclaimed 5900. But then we hit resistance, boom, right at 5950. Just a round number. A lot of the algorithms that trade on the different exchanges, they must have been programmed to say, okay, just stop at that point. Don't do any more buying, at least for a little while. Now, we drifted down. We didn't see a real big pullback, so we still maintain that positive stance. When we retraced some of the gains, we didn't even get down to R2, and then we were able to climb back above R2 this time, and we closed right about at R2. All right, so we were up 1.83%, a really nice gain after the market's been quite lacking in real conviction to the upside. Now, we're not there yet. We still have a ways to go, and you'll see what I mean when I go through the charts here. We were above average with volume, not a huge spike in volume, but we were above average there. And we are now, this is weird. We're positive in the short term. We're still negative, but showing improvements in the intermediate term, and we continue to be positive in the long term. And it's about inflation. Now, inflation's still going up, but this wasn't a blowout number. We've been getting a series of stronger than expected reports lately, especially going back to last Friday with the employment situation report, and that really has spooked the markets. Well, PPI came in kind of friendly, and then CPI came in, which is the big one. That came in and was taken as being friendly for the markets. And so we were getting up to that 5% level with the 30-year. We're even getting kind of close there with the 10-year, but now we're coming back down. We'll see. Is this the start of something or just one of these things that tends to happen and gets everybody really positive about the market and then switches back to negative? There are some concerns. There's always some concerns that I'll go through here in just a moment. And then we have all the geopolitical things. There's the confirmation processes are starting with the Trump 2.0 now. That's really what they've labeled this. And the inauguration coming up. There's things happening, of course, still in Southern California, specifically in Los Angeles with the fires. And there's a potential ceasefire. Last I saw, I don't think it's been official yet, between Hamas and Israel. And maybe that's finally going to calm down. But there's been other ceasefires before, only to have it broken about 20 minutes after it happens. But there's been some threats by Trump 2.0 saying that if the hostages aren't released by the time he becomes president, things are not going to be pretty there. And so maybe that's really influencing getting something done on that path. Okay, so some comments. CPI was taken as friendly. Now, again, it's still up. We still have inflation going up here. And we're still sitting at resistance with the 50-day moving average with the S&P. Banks are starting to come out with their earnings now, and they were strong. JP Morgan came out, Citibank came out, and that really helped the financial sector. So we did have mega caps growth, and I have financials on this list That's a part of the market that we want to see really doing well to help the overall market continue to perform better. Now, we still have a lot of earnings to go, and there's still things that the market can choose to freak out about, but they didn't, at least based on Wednesday's session. And the smart money indicators continue to be positive and are showing an improvement there. We still have a confirmed Hindenburg Omen. Now, well, at some point, this is going to fall off. In fact, I'm going to stop showing that chart unless there's something really big. I think I still have it in today's video, but I plan on dropping that out of here. And in the short term, the Arun indicator is still extreme negative. That's just because it hasn't moved. It hasn't picked up any of this positive action yet. This can be a helpful indicator because it helps us determine what's going on, buying or selling. And that's what this attempts to measure, but it can also lag. It's like we're really moving around with the market, and the Arun just kind of goes sideways and then poof out of apparently nowhere. Then it picks up on something and then changes. And this is easing this idea that, okay, well, there had been some fear coming into the market that is the Fed going to have to come in and actually raise rates, let alone stop cutting them. That was at least put a little bit on the back burner with Wednesday's session. Now it can always come back, but the market, it can be totally happy and everything is just wonderful one day, and the next day it's like the end of the world is coming. So talk about it's like a seventh grade relationship, that maybe if it lasts an afternoon, then that's a long-term relationship. And then we did have the dollar going down. That's been really strong lately, and that's been pressuring stocks. And interest rates were also down. We felt quite a bit with the 10-year yield. We had been at 4.79%. We closed at 4.65%. And I'll probably drop this out of the list for right now. The 30-year yield, it's now down at 4.88%. I was watching this because it was getting really close to that 5% level. And sentiment really didn't improve all that much. We ticked up a couple of notches there to 29 where we had been at 27, but we're not seeing and this could actually be positive for the market. If the market's going up and people are still hedging and it's causing our sentiment gauges to actually not really trust this, this is the wall of worry that the market can sometimes like. We're still negative with our trend, and we're barely coming down to the moving average with the ADX. We're just a little bit above it, both in the short and intermediate term. And the red line is still on top, so we're still negative there. We haven't switched over to positive that way. And we're above 20, so we are trending. And with the update, our bias is positive. And I had been with our momentum, that's the last number of days taken together. I had been mixed to negative. Now I'm switching it from mixed to positive. Now we could go full-blown positive here, but until we see more of our indicators really switching over positive, we want to just be aware of this. So we did get the weekly MBA mortgage applications index, came in up 33 and a third percent. That's a pretty healthy move there. Even with interest rates going up, to see that going up was kind of surprising. And last week it was down 3.7%. Here's the big one. CPI actually came in a little bit stronger than expected with the headline number, up 0.4%, where last time we had a reading up 0.3%, and that's what they expected. So on the surface, it's like, uh-oh, this doesn't look very good. But when you look at the core, it came in as expected, up 0.2%, but it was down from the 0.3% that we saw last time there. Empire State Manufacturing, that really took a bit of a hit there at minus 12.6. They expected it to be at a minus 2. Last time it was at 2.1. All right, now here's a chart. Mortgage applications, a big spike up there. Not sure if it's beginning of the year type things or anyway, we saw a pretty nice upward move with mortgage applications in spite of interest rates going up. Then the Empire State Manufacturing Index is declining after it had been positive but dropping off over the last few months. Here is the CPI on a year-over-year basis. Where you look at the total, it's going up, but now the way they calculate it, the core, the inflation part, it's going back down, and that's really what the market liked. And then you take out services and commodities and look at them on a year-over-year basis, where we're going down with services, excluding energy, and commodities. They've been stronger lately. And the yellow line here, that's actually going up. Here's what we look at first at a year over year basis. That's the rate of change, where CPI is going back up on a headline basis and it's going up on a month over month basis. But when we look at the core, it's continuing to be pretty flat year over year and now actually starting to go down month over month. And this is kind of a different take on this. It's the trailing 12-month headline with alternative shelter metrics because people have to pay to live somewhere. And just showing where we're at right now at the 2.9% level this way, where it had come down from 8.55. And we had been up at 12.5% here. We came down to under 2% with that reading. And then here's the trailing 12-month core inflation alternative, the metrics showing how this is leveling off and getting to a lower level. And this is shelter inflation by itself, where it's actually coming down from what we've seen it before. Just thought this might be kind of interesting to look at. And I actually found this on Twitter, but I don't have it in the Twitter section. I included it here with CPI. All right, and then looking at the bullish percent index, we've been following this pretty. This is a primary indicator. Now, this is before Wednesday's upward move, and we're coming in with a low reading at 40.6, and we've been seeing that too, and it's been coming down. And then stocks have historically done better under re-elected presidents early in their second terms. Well, that's not what happened this time, and so they're looking at the it's a new president, but not really, because this is Trump 2.0, where we tend to underperform in the first year. This is kind of an exception going back to Grover Cleveland when he was president, then not president for 4 years, and then president again. So I don't know. That was way back in the 1800s. So I'm not sure how much of a comparison we can do there. And because we've been under pressure lately, you're seeing more doom and gloom type charts, and we'll probably see more rosy ones if things continue to go up. But these are the annualized 10-year returns, and this is going out to 2023, 2034. My goodness, 10 years from now. And of course, since we're looking not so good these days, the numbers project that we're actually going to go down. And who knows what will really happen there. And the risk appetite has been dropping off as the near-term outlook for the market has been dropping off. And that will probably change if we can continue to go up. And the dollar, DXY is one of the dollar indexes. I follow a different one that I've stuck with for quite a while. This is the long positioning. It just shows that a lot of folks are in the dollar. And it may be overbought, not only from a price perspective, but so many people are piling into it that, okay, there's nobody left to buy. Everybody that wanted to buy has buyed. And so maybe now that will start bringing the dollar down, which could help stocks. But, if you want to go on a trip or something like that, you like the exchange rate. Then trade policy uncertainty, this is just going up right now because and in some ways, Trump 2.0, that's what they want. It's like, well, he could do this, he could do that. We don't know what he's going to do. Maybe we better sit down and talk about this. And because the tariffs and all these things going on back and forth, it's just producing a lot of uncertainty, which the stock market does not like. But this if you're a negotiator and you want the other side guessing instead of thinking that they have you all figured out, if you're doing a business deal or if you're doing from country to country. All right, then this is how money has been flowing into different kinds of bonds out there. Awful lot of money going into money markets now as, okay, do we get into bonds? Do we get into government bonds? Do we get into junk bonds? What are we doing? So a lot of money's just ended up in cash lately. And this is kind of a funky one. Looking at the below. I've never at the below. That's interesting. What do you think inflation will average in the following in the different regions, whether you're talking about Europe or the US over the next 5 years? And if you can get something out of this, go for it. But it looks like here they're looking at inflation actually. Well, this is what it was doing, and this is what they're projecting things out to be. Mainly, we're focusing on the fourth quarter here of 2024. All right, kind of a weird looking chart, but Some of you might find that somewhat useful. Earnings sentiment, where we look at the dark blue line here, this is the S&P 500, where it has been coming down and it's ticking back up a little bit these days. And then it shows you how that's in relation to other earnings sentiments, just the feeling that earnings are going to be better or worse across the world. I spent some time on Twitter, but didn't really find anything all that useful here. Here's the intraday chart, and we never did hit R3. It was up quite a bit higher than where we were at, but we saw just a really big gap here above R2 right to open the day. We came right up to 59.50, and then we started to pull back. And then this is when the market had to make a decision. Are we going to continue to sell or are we going to come back in and buy? We saw buying coming back in, took us back above the 59.50 level, even got above that, but then we came right back down and closed the 59.50 level. Intraday, we're up just a little bit to slightly unchanged when I last checked the futures, but we were actually coming down a little bit with the futures, and then we started to see things get a little bit better. They were positive even before CPI came out, and then we saw the real big spike up before the open, and so we could be looking a little bit better here. We go back to the 13th now of January, and we're seeing things looking a little bit better. But now, can it continue, or is it going to go back into being more choppy? Still looking good here, and we have been pretty much since the end of November into December, where we see growth outperforming value. The blue line is above the red line, and both had a good day, but growth outperformed. This is showing some improvement here as well. This goes back to the latter part of November, where we're seeing S&P growth to value intraday doing good. And even when we've been under pressure lately, it's been trailing off a little bit, but it hasn't really fallen apart. We'll see if we can get more follow through with this. End of day, growth was up 2.4%. Value had a good day too. Everything was up. Value was up 1.29%. Growth was up more with the mid caps and up more with the small caps. But we're coming down a little bit here with our end of day ratios. But small cap growth is still in an uptrend. We're seeing a little bit of a breakout, but we really haven't got out of this range that small caps have been in. We got a little bit above it and then came down, closed well off the high for the small caps, right at the higher end of this range. And a little bit of a tick up with mid caps. Now, this ended up getting a little bit out of its range, but also closed well off of its high there. Where with the S&P, we ended up closing just about at the high. And we're going back up and still looking pretty solid here with the growth to value ratio and ticking back up after showing some weakness when we look at the growth versus value ETF. Discretionary to staples is still really strong, one of the stronger areas of the market. Where staples was one of the few of it was the weakest sector. It was down at one point. We'll have to look at it here in a moment. But discretionary, it's back up to its 50-day moving average here with this equal weight ETF. Can it get above that? And we're back above the 50-day moving average with large cap growth. So that's showing an improvement after we had dropped below that level. And here is the trend. And you can see the ADX coming down hasn't quite crossed below the moving average. The red line's coming down, the green line's coming up, but we have not switched over positive yet that way. And we haven't crossed below the moving average. We're really close. If you look at the numbers over here on the left, it still shows that we're slightly above the moving average. But the red line is coming down and the green line's coming up. So a lot of improvement, but hasn't switched to positive yet. And we were above average with volume. Okay, sentiment. We did get the latest reading of Investors Intelligence all the way down to 1.32. Yeah, they're rather pessimistic in their latest reading. Now, there's some lag time here. And of course, if we keep going up from here, that's going to switch more over to positive. We're still getting a pretty high reading with the Ulcer Index when we look at sentiment that way. We're coming down with the VIX. That's more positive for stocks, coming down to the lower end of the moving average, the lower moving average here with the line chart as well as the bar chart, and the VIX of the VIX also continues to go down. The momentum rolling over, but hasn't quite switched to negative yet with the VIX. We need to see some more down days to turn the MACD more negative, which is positive for stocks. And now we're back up into this range again. We still have a couple of days left before options expiration for January, but we were really coming down with the skew index because this is calculated using out of the money options. Now we're right back up there again. So they're still expecting some kind of a big move. And we came down with this fear gauge, and we also declined with the other fear gauge. So we saw more confirmation there as far as sentiment. And we did really go up though with the equity put call ratio on the daily chart, and we're still going up with the 5-day chart with a longer term look right here. And this is at a pretty low level. That's why I'm showing this longer term here, because sometimes this can end up being more negative for the market. But we're going down with the 10 days, so we're seeing a little bit of a mix there. Volatility risk premium. This is one area that was not showing an awful lot of fear. We stayed down below this band here and actually dropped down. Still not showing an awful lot of fear going out 30 days there. And seeing an improvement with the advanced decline line based on price and volume, but still longer term positive since we're above the moving averages. Seeing an improvement here. We saw a few new lows, but we saw a pretty nice little expansion of new highs. So we're turning back up and crossing above the moving average with the 5-day, and we're starting to go back up with the 10-day. We're crossing above zero with the advanced decline ratio, both in the short term and intermediate term. It's hard to see, but the red line is just barely positive there. So an improvement that way. We're still looking positive here with the accumulation distribution. This is a smart money indicator, and we're going up above the moving average. That's positive. We're also even more positive now with the Chaikin money flow. We were looking good since the red line was coming back up, and this is what we were picking out here. And now it's actually turned positive by looking even more green than it had been after Tuesday. And we're going up with the Chaikin oscillator. So our three smart money indicators are now back to positive. Coming down with the red line, not really going up with the green line here with the vortex, but this is still negative, but improving because the red line's coming down. A little bit of a tick up here with the advanced decline line on a cumulative basis for the S&P, both based on price and volume. And we're improving with our advancers minus decliners. The 10-day moving average is above zero and continuing to improve there. Going back up with the advanced decline line on the NYSE after we came down to the 200-day moving average and showing a little bit of an improvement longer term with the 10-day S&P highs minus the lows, but we're still below 50. And with the NYSE cumulative advanced decline line based on price, we saw a nice little advance there. Coming up, but not really getting out of this recent range with our regular NYSE advanced decline line. Same thing here, just kind of in the range and still under the moving average with this other NYSE advanced decline line, showing an improvement with common stock based on price and volume. And an improvement, but not above the moving averages yet with all the different indexes that we follow for the advanced decline line studies. This is improving a little bit, but still kind of negative when we take a broad market measure of the 5-period moving average of the highs and lows. Still getting kind of a low reading there. And we're crossing back above 50 with those stocks in the S&P above their 20-period moving average. The short-term trend is looking better for right now. And then with the study that we look at, we need to get up here to 70 pretty quick. Now, one thing that we've noticed with this chart is we came down and then we came down, set a higher low, then went up, came back down, at least to this point, set a higher low here, and now we're starting to come up out of that. If this can continue to go up and eventually get above 70, that would show good, solid, short-term upward momentum. Okay, seeing an improvement with the 50-period simple moving average and the 100, as well as the 200. Then looking at the short-term chart, we're coming right back up to the 50-day moving average and have not been able to clear that at least yet. On the bottom, we are above the moving average with volume. This is one thing I wanted to point out. This is just mainly focusing on the structure of the price action that we're seeing. I plotted the close, that's the line chart, and then the bar chart, which is the open, high, low, close. We have not broke this series of lower lows and lower highs yet. We need to come up and clear above this red line for that to really kick in and take over. Now we have pretty much come back and filled in the gap from the election. It's a little harder to see here because I have a line chart going. But after the election, the market really liked that and we shot up. Now we've come back and we've filled that. Was that what the market was waiting for? Now can we finally go forward from here and start to look more positive? But it's still looking vulnerable with lower highs and lower lows until we can break above these previous highs. Okay, showing an improvement with the 20, 50, and 200 period moving averages, crossing back above the midpoint with the Stochc RSI. The Williams percent R also showing an improvement. The CCI 14, which was extreme negative, is now crossing above the midpoint, and we're right about at the midpoint with the CCI 20. The stochastics, which never really had enough to be extreme positive or negative for any length of time, looking a little more positive, crossing above the midpoint in the short term, going back up in the intermediate term, still declining with the longer term. Now, again, this is a further subdivision of the short term time frame. And we turn back positive with the force index getting back above the lines here with the short-term trend. We're above the blue line and the green line here. If we can stay above that and see these lines go back up, that will obviously be more positive. And we're back above the simple and exponential moving averages based on 20 periods. We're above the midpoint with our standard deviations chart. Intermediate term, little bit of a tick up with the balance of power. It didn't really pick up all that much strength based on how it's calculated. And we're going back to a lighter shade of purple now with the go no go, but it hasn't switched to positive. Coming back above the midpoint here with our highest high, lowest low value chart. The TTM squeeze picked up some strength, so now we're red, but we're turning to the lighter shade of red. And so that's picking up some improvement there. We're going up, but still negative with the ease of movement. The Arun, as I said, just kind of, what? Something happened? I was asleep. And we're looking better here above zero with the McClellan oscillator for the S&P. We started to pick this up after Tuesday. We're going back up based on price and volume. This is another primary indicator that's switching back positive. And the NYSE McClellan oscillator has turned back positive above zero again. So we're turning back up based on price and volume there. This could show a real improvement if it can see more follow through. Where we were seeing a real divergence, we were going up with the Swenlin trading oscillator based on price. We were going down based on volume. Now they're both going up. Now price is a little more positive. It's above zero. We're still below zero with the volume. That would be even more positive if it could get above zero. But the thing that I pay attention to most with this chart is what is the direction? Not so much are they above or below zero. And seeing a little bit of an improvement with the momentum as measured by the PMO. We're actually crossing positive based on price, trying to get a little bit above the moving average here based on volume. The PMOs that are rising, that's going up. The buy signals are going up. And we had been seeing an improvement with the buy signals. And we're starting to slowly turn back up with the PMOs that are above zero. We've gone from neutral to positive with the Elder's Impulse system for the S&P, but we're still negative with the parabolic SAR. We've got to clear these previous lower highs here for that to look more positive. And showing an improvement in the short term with our slope oscillator, it's no longer extreme. It's coming back above this red line and above its moving average, ticking up, but still negative with the MACD. So the slope oscillator is actually looking about the best. We're improving with the TSI or other short-term oscillator, but we haven't crossed above the moving average. We're still going down, but showing an improvement in the intermediate term, where we're still declining with the long term. Seeing a little bit of a bottoming here with our other long-term oscillator, the KST, and trying to get above the moving average, but not quite turning positive, at least yet, with the Copic curve momentum oscillator. Going back up with the Sean trend meter, that's showing an improvement there. Just ticking up barely, but still below 50 with the money flow. We're above 50 and going up with the ultimate oscillator. Going back up above the moving average with on-balance volume. Starting to cross back above 50 with the RSI 14 and the RSI 9. Still below the blue line, but we're coming back up to the red line here. This is the condition of the intermediate term trend. It's going to take a little bit more for this to turn back and look more positive. And we're right up to the simple moving average. We closed, that was the high, and we closed just about at that point in Wednesday's session. We're going to need to clear that to have things turn back more positive. So we're actually above some of the 20 period moving averages here, but still below the 50 simple. moving average. But the 100 held up, at least for right now. It provided some pretty good support there. We're watching the mass index. Two out of the three criteria have been triggered. We've gone above the red dashed line and the blue line. We're waiting to see this come back down now to trigger the third part. And that tries to signal that there will be a reversal in the market. And the Pring bottom fisher, this is right now anyway, looking like it was a pretty good signal that it was giving to us. And we're going back up and actually turning positive. We're seeing a jumbled mess here with the bullish percent index. But if this could keep going up, that will naturally be more positive. Going back up with the NYSE BPI and the NASDAQ 100 BPI, but both are still below 50, but they are improving. And we're coming back up in here into our little mini rainbow. This is a 20 period simple moving average of the open, high, low, close. Coming back up to the open and close part. I think that's what that is. We need to clear this and then get above all of these lines and see the mini rainbow to go back up to be even more positive. Coming back up into the cloud, the higher end of the cloud now with Ichimoku. We still have the blue line below the red line, but the green line here is going up. So an improvement, but not positive yet. This is longer term. We're wondering if we can get back up to the top end of this trend channel going back to 2009. We're turning positive with the Heiken Ashi. We have an open candle there. We're still negative with the Kegi, but pointing up. And we're still negative with the Renko chart, and we're negative with the three-line break. So we're not seeing a real uh, confirmation there of the different way we measure the trends. But we did see three new X's drawn in here with the upward move in Wednesday's session. But we're still dealing with a bear top. Okay. I don't know why that's green. Maybe because of the green thing. We need to get above this. Get it back above the 6,000 level and put in some new X's here to wipe out this. You can see here we have a lot of prices right here at this top. We need to break above that to make it look a little more positive that way. All right. And an improvement here with our 150 and 200 period moving averages. And we're back to looking positive in the short term, where we had been negative with all of our different stock indexes. We're still negative intermediate term with the mid caps and small caps. Bonds are still negative across the board. They've got a lot of damage to repair. We're still seeing commodities positive in the short and intermediate term. And the only, yeah, staples was the one sector that ended up being down. All the other ones were up. And the areas that we want to see doing well did well. Financials, banks, discretionary, more growth, tech and communication. These were the stronger areas. When these four areas, and I usually pick them out as three, but we also keep an eye on the financials. When all these areas are doing really well, the market does really well. Now, can we see follow through with this? Are these going to continue to go up and be more of a leadership in the market? If so, then things could turn quite positive for the market. And I'll go blue or green here, depending on what you see. We had a MACD crossover with the Dow. We had a MACD crossover with the financial sector as well as a BPI. See, it been kind of weak. It dropped below 50. Then we had the S&P above 5,900, and then the NASDAQ bouncing all over. 19.1, 19.2, 19.3, 19.4, 19.5. Woohoo! And then the tech sector had a BPI cross above 50. That had been seeing some weakness lately. And the Dow immediately got back above 43,000. And seeing an improvement here, but still a bit of a disconnect. When the red line's far away from the bar chart, that means the equal weight is underperforming the weighted version of the S&P. And going back up a little bit here with our ratio, where we had and it would probably be more positive for the S&P for this ratio to go up. That means that the bigger stocks are really controlling price. The Dow had a pretty good day, but stopped right at this pivot point, still below its 50-day moving average. But we switched to positive with the diamonds when looking at the Elder's Impulse system, coming right up to this pivot point with the NASDAQ. But the 50 period moving averages were recaptured there, both on the NASDAQ and here on the NASDAQ 100, but also having some overhead resistance right at the pivot point here. And we've gone from negative to positive with the Qs when looking at the Elder's Impulse system. The momentum is still negative, but improving. And we're above the 50-day moving average, but still below the 20-day moving average with the triple Qs. Small caps, and the concerning part is that they closed well off of their high, but they were up 1.63% here, still below this pivot point. And here is the Russell 2000 small caps, where if you go back to the previous one, we came down to the 200-day moving average with this index. We bounced off of the 200-day moving average here. So that could be positive, and there's a bit of a gap here. But we've spent so much time in this area. It's like, okay, we're going to really go down and fill this gap now, or are we going to be able to continue to go up? And we've gone from neutral to positive with the small caps, with the Elder's Impulse system, and see how we just kind of got right to the 50-day moving average with the mid caps, and we closed just about where we opened. That's not really all that great. Not bad, up 1.29%, but not a lot of follow through strength within the day. But we're still positive though with the Elder's Impulse system for the mid caps. And coming up to the 50-day moving average, I usually show this in the intermarket analysis or deep dive video. The bank ETF came right up to its 50-day moving average, but it's still below that. It's going to be more positive if we can get above it. And we are above the 50-day moving average again with the financial sector. So banks are just a small part of the overall financial sector itself. And when I mean small, I mean big. All right. And then the Wilshire 5000 still underneath its 50-day moving average. And getting back up to the 50-day moving average with the total US stock ETF, we still held at the 50-day moving average with the FANG index and have been able to bounce up off of that. We're coming up off of this longer term trend line, and we still have a ways to go to get back to the upper trend line. And all the mega caps, the Magnificent Seven, they were up. Apple was up almost 2%, getting back up to its 50-day moving average. We were up to over 2.5% with Amazon, 2.5% with Microsoft, still dealing with its 50 and 200-day moving averages, but showing an improvement there. Google was up over 3%. Meta was up almost 4%, well above its 50-day moving average. Nvidia was up 3.4%, still under its 50-day moving average. Tesla was up over 8%. Yeah, all right, pretty good day there. And Netflix was up and still below its 50-day moving average, though, up 2.4%. The semiconductors were up 2.35%, still above their 50-day moving average here with the SMH semiconductor ETF. And coming back up here, it's going to be nice to see if we can get back to these previous high levels with the semiconductors. If we even get there, can we finally break out above these previous highs? And we saw a little bit of an improvement, but tech had a good day, semis had a good day, but on a relative basis, the semiconductors did not outperform tech. And coming back and getting a little bit above its 50-day moving average with the Dow Jones Semiconductor Index. But we're still in a downtrend with the SOX index, but we're getting above the 50-day moving average. We have not come back above the 200-day moving average, at least yet. And internationally, when we compare it to US stocks, the short-term correlation is getting a lot stronger, and we're seeing a gradual improvement with the longer-term correlation. Oil back up now. We're getting up into the 78 range there, and we're still, well, we came a little bit back up to the moving average here. Looking at the total bond ETF, we need to recapture this 200-day moving average to turn more positive. We may treat this as overhead resistance if we can't get above this 200-day moving average. The dollar did pull back. It's up a little bit in the overnight session here, but we got up into the 110 range intraday. We got up into the high 109s. Now we're dropping down into the low 109s. And we really dropped off with the 10-year yield, and the stock market really liked that. And we really went up with the 10-year based on price. We're seeing a bit of an improvement here with our home construction to 3 to 7-year bonds, but we're still well underneath this rainbow. A lot of damage has been done. A lot's going to need to happen to turn this back to looking more positive. And here's where I showed this again, okay, in case you didn't see it before. All right. Then we are seeing an improvement with our growth to value ratios, coming back up to the moving average with the Qs to S&P, getting above the moving average with discretionary to S&P, coming back up, but still below the moving average with large cap growth versus large cap value, coming back up with the large caps, right about at the moving average with the mid caps, and about at the moving average with the small caps. Seeing a drop off here. Staples was down, the S&P was up, and so we're seeing this ratio going down. That's positive for the S&P. So what's our outlook for Thursday? We are starting to get into earnings season now, and that's going to be a large part of the catalyst that drives the market when the real big companies come out and do their reporting. We're really improving with the S&P, but we're still below the 50-day moving average. We're going to get retail sales and all the jobless, either the initial claims or the continuing claims on Thursday, the Philadelphia Fed Index, and then not real influential, the import and export prices as well as wholesale inventories, and then the NAHB Housing Market Index, Empire State Manufacturing, kind of a long list for Thursday. And then the geopolitical things, just to see if any of that comes in and actually has an impact on the markets. Okay, then Friday we're going to get housing starts and building permits, as well as industrial production and capacity utilization. And let's see that, and I'm trying to update this. Usually I just put this up here for the week, but I'm going to try to update this so that we not only see what the previous was, what the forecast was, and then what the actual came up to being here. And then seasonality for January 16th, we're neutral to positive with the Dow, where we're positive for the S&P and NASDAQ. So that could end up being fairly positive over the last 21 years, that January 16th tends to be a pretty good day there. And then we're coming up here into some positive seasonality with the green dash line as well as some of the other indexes. And then we will have options expiration here on the 17th. And that can always produce some volatility there. We're starting to get out of the first half of January, which is generally a better performing time, and we're coming into the second half of January. Small caps improving, but just kind of at the high end of their range, not really rocketing up the way the expectations have been. And we're still in this positive time now, according to Tom Bowley's research. So the warning signs, we're improving with a lot of these, but we're still negative with the advanced decline line studies. And this isn't this little, we're going up with the 5-day and down with the 10-day. So we're getting a mixed picture there, but we're still negative with the parabolic SAR. The momentum is improving, but still negative. We still have a confirmed Hindenburg-Ullman. The vortex, still negative. Our moving average studies are improving, but still negative. The ease of movement, negative but improving. The money flow is still negative. The momentum for the NASDAQ 100 is negative but improving. All right, then our smart money indicators, and this is what really gave us some heads up. We were seeing this after last Friday, and then we saw a follow through with Monday, and then Tuesday. Things were looking better when you take all three of these together. The smart money was coming in and doing some buying. We're still looking good here with growth to value. We were getting a little bit down after Tuesday's session, but the discretionary to staples, that's doing really good right now. And we're back to positive with our S&P as well as NYSE McClellan oscillators and summation indexes. And now we're looking positive again with the Swenlin trading oscillator, where we had been seeing a divergence between price and volume. And we're turning back up and looking better with our bullish percent indexes. And we're still above 50 with the 200 and showed more improvement there. The ultimate oscillator is positive in the financial sector. It never switched over negative. We were just drifting below the 50-day moving average. All right, our conclusion, we are turning positive. Now, I say turning because we're not there yet, and this could be lost if we suddenly shift and go to the downside. So right now, though, we are looking better and improving along the way with large caps looking better, and growth is pretty strong right now. We're actually back to being positive in the short term and improving where we regain the 20 period moving averages, but we're still negative as measured by the moving averages in the intermediate term, but looking better. All right. And then we continue to be positive in the long term. Thank you. Have a really good day. I hope you found this video helpful, and I will talk to you in the next video.